Hello, everybody. Professor Barth here, Associate Professor of History at Arizona State University. Rate hike at the Federal Reserve. Of course, the big announcement today coming from the FOMC, the Federal Open Market Committee. The Fed is raising interest rates, the federal funds rate, by 75 basis points, by 3/4 of a percentage point. Now the upper limit of the federal funds rate is 2.5%. which is the highest the federal funds rate has been since 2019. Of course, the Fed plunged interest rates in the midst of the COVID panic hysteria, kept interest rates extraordinarily low, at zero, up until this calendar year. And then people are surprised there's inflation. Where did it come from? Why is there inflation? Well, all you have to do is look at the graphs, the charts, and not just this one, but also a few others. We'll see those in a second. But the Fed they're acting aggressively. And in videos, or in earlier videos this year, I said, if the Fed is to bring inflation under control, they're going to have to be aggressive. And so now we've had 2 meetings in a row in which the Fed raised rates by 3/4 of a percentage point, and then the meeting before that, 3 meetings ago, the Fed raised rates by 0.5 percentage point. So the Fed is acting aggressively, or more aggressive than it has in a long time. And now, of course, it's because the consumer price index is off the charts. We're at 9.1%. If you're a renter, your inflation is in double digits. But the official CPI numbers, 9%. And here's zoomed out from 2010 to 2022. Look at this. Inflation is wild right now. By the way, expect when the July numbers come out in early August, I would my guess is that it might be lower than 9.1% because gas prices have come down, but we'll have to see. Nonetheless, this is historic inflation, over the highest inflation we've seen in 40 years, and there are no signs of slowing down. So the Fed has no choice but to raise rates at the highest level since the 1990s. The highest rate increases since I think 1994 is the last time the Fed had raised rates by 3/4 of a percentage point. CPI month over month. I mean, these are dreadful figures. In the month of June, CPI went up 1.3%. That is the largest month over month increase since this inflation spiral began. And again, the Fed is like, who could have known? Who could have predicted it? Well, if you look at the data, it wasn't too difficult to predict. Federal Reserve assets in 2020, or beginning in 2020, doubled between 2020 and the end of 2021. Its balance sheet doubled. Trillions and trillions of dollars of QE. Over $4 trillion of quantitative easing pumped into the economy. Of course, the value of the dollar is going to go down. This is basic supply and demand, laws of economics. And look at the money supply here. This is a M2 money supply from 2017 to 2022. Here's when COVID erupted. Look at that. Huge spike in the money supply. Over 40% increase in the money supply since COVID, since the COVID panic. Of course there's going to be inflation. Of course there's going to be inflation. And a lot of people saw it coming. I wasn't the only one, although I did see it coming. A lot of people saw it coming. Larry Summers was not the only one to see it. I see it all the time. Larry Summers, people act like Larry Summers, he was like a prophet. He said in spring or summer of 2021 that inflation would be a problem. Shoot, I was saying that in 2020. I was saying that like right here, that inflation was going to be real bad, like early on in the COVID pandemic when they were giving out stimulus checks to everybody of just made up monopoly money. I remember thinking at that time, this is going to be inflationary. In fact, and I know a lot of people were saying that. There were a lot of people just in general conversation saying, whoa, what does this mean for a dollar? Larry Summers was the only one to see it. Give me a break. But of course there was inflation. Look at the money supply. So here's where we are with the federal funds rate. This is the target rate is a range of 0.25%. So we're at 2.25%, between 2.25% and 2.5%. Matches 2019. Look at that after the financial crisis. But historically speaking, 2.5% upper limit is still low. I mean, in late 2000s, leading up to the financial crisis, interest rates were above 5%. So we could be in for many more increases before things begin to settle down here. Now, Jerome Powell and the FOMC released their official statement today. And among other things, Powell was asked in a Senate testimony before the Senate Banking Committee, I think it was last month, is this Putin's price hike? Does this have anything to do with Putin? And Powell said, actually, inflation was a problem way before the war in Ukraine, so I can't say that Putin is responsible, is the primary culprit here for the inflation. It might have some effect here and there, but inflation was a problem before Ukraine. Before the war in Ukraine. Now the FOMC is playing ball. Look at this. Russia's war against Ukraine is causing tremendous human and economic hardship. The war and related events are creating additional upward pressure on inflation and are weighing on global economic activity. So, again, pointing the finger. It's not our fault, Russia's fault. And then they announce their plan here, federal funds rate go up to 2.5%. In addition, the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. That's quantitative tightening. Right now, the plan through the end of August, the Fed will allow $47.5 billion of securities to roll off its balance sheet, and then beginning in September, it's going to be, I believe, $95 billion a month. That's only going to be a dent in the Fed's overall balance sheet. So I would expect if inflation persists as a major problem, and again, even if the CPI increase is a little lower for the month of July, a little less than 9.1%, I think this is a long-term problem here. The Fed is going to have to accelerate quantitative tightening more than the current plan. Jerome Powell was part of a panel at a European central banking conference. Wall Street Silver Twitter account transcribed some of this for us. He said at this conference, "I think we now understand better how little we understand about inflation." He was saying basically, like, who could have seen this happening? The host said, well, that's not very reassuring. And he said, well, this was unpredicted. And Wall Street Silver points out correctly, only the so-called experts in the media didn't see this coming. Just about everyone else did. And again, if you look at videos I made, this is a video I made about the impact of the COVID lockdowns back in, I made this video in November 2020. I have a section in here about the Fed's monetary policy and how it was putting the dollar at risk. That's in November 2020, almost 2 years ago. And then I made another, this was toward the end of my History of Money lecture series. I'm not tooting my own horn, I'm just saying, giving one example of many. I mean, a lot of people were out there saying this was going to cause inflation. I was one guy out there saying it. And many others were saying it too. But this was in December of 2020, and I said the same thing, the value of the dollar is at risk. So this is disingenuous, unpredicted. All you had to do was look at the data. and it was obvious inflation was going to become a problem. So Powell gave a press conference today. His opening statement, he said, "We anticipate that ongoing increases in the target range for a federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy." So, and then in the Q&A, he left open the possibility of further 75 basis point increases, and possibly he was even asked, what about a 100 basis point increase, a full percentage point increase at a future FOMC meeting? And he said, look, we're going to do what we need to do, but we aren't going to try to predict exactly where we're going next. He said, this is unpredictable. While another unusually large increase could be appropriate at our next meeting, that is a decision that will depend on the data we get between now and then. As monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised over the past year, and further surprises could be in store. So that's that. We'll see what happens next, and what impact this will have on our current economic climate. The Dow is up today. So a lot remains to be seen. Until next time, God bless.